Hi, everyone. I'm Ivan Biuki, and welcome back to Wall Street Silver. Our guest today is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. Gareth, it's great to see you.
Thank you guys for having me back. It's so awesome to be back.
Yeah, absolute pleasure.
So, hey, Gareth, you are known as, one of these market strategists. You're on top of these things on a daily basis. And in the past week, we have the market down 900, up 400, down, the market's doing these wild swings. And it reminds me of February, March 2020. I mean, do you are we in that nervous moment? What are you seeing?
Yeah, I think it's very much like that. When you see a market that's, down and up 2% almost on a daily basis, it's telling you that investors honestly have no clue. There's so many kind of mixed signals coming into the market. We've heard recently from Jerome Powell talking about how, inflation is no longer transitory. By the way, I've been saying that for the last 6 to 12 months that it wasn't going to be transitory, but finally the Fed is admitting it. And they're starting to take a more kind of hawkish view in terms of inflation, which, for people like me, I like that. I don't like my dollars being diluted, right? But ultimately, what it tells us is that the Fed may not and no longer be the market's friend. And that's what's causing this kind of angst in the stock market over the last week or two. So it is wild times. It's a time to be conservative. The charts to me continue to look overdone. In fact, let me quickly show this chart. I think it's such a cool chart to see. This is the NASDAQ 100. And what you can see is the market has been stuck in this channel for the last, really going back to, 2020, right? And you can just see how you go to the high end, you sell off to the low end, back up to the high end, down to the low. And you can see recently we just pierced that upper trend line. So to me, that tells me downside likely until that lower area there. And then once we get there, the question is, can the markets bounce off of it again? In general, you would say yes until proven otherwise. If we flip to the spiders, is this channel that we've been trading in. And again, on the S&P, we just tagged the upper area right here. So to see selling is not a surprise. Same thing on the NASDAQ 100 here. You can see this beautiful kind of parallel line that we've been stuck in, this channel. And look at that. We pierced right there. Nasty reversal on the candle. Look at that nasty red reversal. And then all of this is that inside bar chop that we've been seeing recently, where you're kind of getting this, up, down 2% type price action, which again is telling us that this market is unsure. The Fed is no longer being super helpful. Will the Fed continue to save the market? And that's what's creating the volatility and angst.
Is it this new variant that, Omicron, it seems like everyone's talking about this week? Everyone was super scared last weekend. Is like, are we doing lockdowns again? People are shutting down travel to countries. But then this week it seems to be like, oh, it's not that bad. It's a mild version of COVID, so it's not that big of a deal. But then that goes into, all right, is the Fed now tapering, not tapering? I mean, people don't know what to think right now, right?
Right. And I think that's exactly what's creating this volatility. And this is my take on it. I don't think the variant itself is an issue, right? I mean, we saw COVID in March of 2020. Yeah, we panicked because it was brand new. And then the markets roared to new all-time highs. So what's different? I mean, here's a variant that, we're used to these type of things now. So why is the market getting freaked out? The answer is this, right? In 2020, inflation was very low. It's now 8%. In 2020, the Fed could come out with their bazookas, print tons of money. The government came out, sent stimulus checks to everybody, and that was what they could do. You now have 8% inflation. The Fed cannot do the same thing again. So it's creating, that's the kicker, right? If the Fed could print unlimited money, no one would care about the new variant. They would just print us out of it. But they can't do that. And Jerome Powell recently has told us that, and that's what's causing a lot of that panic.
Well, here's the producer price index numbers for some of the top manufacturing. This is a little graph I keep. Whenever they update each month, I just change the latest number. And these are year over year numbers. And these are the biggest manufacturing economies. So this is what's coming down the pipeline. But at the same time, the Fed can't raise rates, right? There's too much debt. It's like, all right, what do they do? What do they do?
Yeah, I mean, the Fed has really boxed themselves in. I mean, the writing was on the wall. It's just the market tends to not care until it has to care, right? Which is why, people were just piling in the stock market. Average investors are classic players to get into the market late, right? So we've seen in the last year more money come in from average investors into the stock market than really the last, I think, 10 or 20 years combined, which is incredible. And by the way, that's never a helpful thing, right? Never a good thing when you see the small investor piling in. So I'm in this position of saying, okay, you got to be conservative here. I have a fair amount of shorts out there. I do have some positions on the long side, but they're value plays. They're positions that are going to make me, get a dividend. They're already down at 52-week or multi-year lows, and they're good quality companies. You're not going to find me investing in high-tech growth right now because, again, I think that that's where you could see the biggest decline in the future.
It seems like the central banks are starting to get concerned. We just saw Singapore buy gold for the first time. We just saw on Wednesday this week, we saw the Bank of Ireland buy gold for the first time since 2009. I just tweeted out this on Wednesday. These are signs, right? When people, how do you? I know you do a little bit in precious metals also. You're more of a broad, you do the whole market, but you do watch gold and silver also. What are you thinking right now when you see big central banks buying gold that haven't done it in a decade?
I've been saying for the last year or so that pullbacks on gold, you have to be buyers. All right. I mean, if you just understand the metrics that have gone on, the amount of money globally from all central banks that have been printed, it's not just the Federal Reserve here in the US, it's all central banks have been printing. And like you mentioned just a second ago, is that, interest rates can go up a little bit, but if they go up too high, the US is going to go bankrupt, right? The debt payments become too big. So there's going to have to be at some point, keeping interest rates down, printing more money. The next black swan event that causes a 50% decline in the stock market, the Fed will have to come out because unemployment is going to get so high. And again, that means that assets that can't be printed like gold, yes, it's mined, but there's a limited supply. Those are the ones you want to be in. If we take a look at the chart is confirming this 100%, right? This is the gold chart here. And you could see that we had this big run up where we got to those highs, around almost 2,100 on spot gold. And then this choppy action, a lot of investors are like, oh, gold is dead. It's not doing anything. This is actually bullish consolidation. It's digesting this massive move up we saw in gold. And again, what you can do is you can draw a trend line right here, and you could see, again, that beautiful consolidation. You can even put a trend line underneath here, which gives you that kind of parallel, same kind of consolidation lines. And you're basically consolidating at this point. You're looking for a breakout above this blue trend line here. And when that happens, you're going to see a major move in gold, easily back to 2,100. I think of 2022, you're looking at $3,000 an ounce by year end.
Wow. In the middle of that trend line, that channel you have right there on the screen right now, that looks like about 1,900. Would you, from a technical perspective, would you get excited if you saw it not just breaking the blue trend line down in the 1800s, you'd want to see a break of that middle one, that middle peak?
Yeah, so I think, for the biggest thing for me, it's noticing the consolidation, these parallel lines, how price has just gone very sideways with a little bit of downside. And part of that is, again, if you just factor in Bitcoin and the money that Bitcoin's taken away from gold in the short term, that almost explains why you've pulled back a little bit in gold. But gold is still holding up amazingly well on the longer term chart if you zoom out here, right? Look at from this low going back to 2018 to the run up into the 2020 highs in August, right? Massive move to the upside there, almost 100%. And then all you've done here is pull back from the 2,100 or just sub 2,100 level, and you're hovering around 1,800. That's a beautiful position. And what you're looking for, again, for me, the big breakout would occur at this area, this blue trend line right here, around 1,850 to 1,900. Right here, when you can, basically blow through that, you're going to get a big move. It should be a cataclysmic blast off type breakout on gold. And I think you'll see, again, a very quick move within months back to the 2065 to 2075 level there on gold.
Could you zoom out, bring that back up? Could you zoom out to the full, 2008 and show that the cup to 2008?
Let me see if I can go to a bigger time frame here so we can get more. There we go.
Oh, nice.
Yeah. So there you see your big cup and you see the handle forming.
You're absolutely right. That is an absolutely beautiful cup and handle pattern. And I think you can see here again, what you've seen is you saw this consolidation here and then the massive run. and then again consolidation, and then it's setting up to make that another big move. And you could argue that if you go back to where it was really basing here, you could be basing in the same thing and have that type of major move to the upside in play when it breaks out. So again, beautiful idea to zoom out on. This is the weekly chart now on the spot gold price, and you can see again how this is a beautiful cup and handle pattern.
Well, we just how do you play this? I mean, if some people do physical, but if you wanted more leverage to the big move here, would it be in the royalty companies? Would it be certain miners, or what's the way to play gold for maximum effect without doing options where you have time decay? Yeah. If someone wants to just buy, I mean, where do you look? The royalty companies or the miners, or what?
I think, again, if you look at the percentage moves in the miners after a gold move, usually you'll get 2-3 times the move in the miners. So I think the miners would be a great way to play it. You could play the GDX, right? And the GDX, you can see the same sort of pattern. Here's your cup, here's your handle formation. And again, very simply just seeing this trend line here, take this high and just drop it down. And then that's your breakout line right there, which looks like around $36 on the GLD. But again, what's amazing about the GLD is if you go back to 2011 over here, you've never even retraced back to that high. And what's beautiful about that is if you get a breakout here, you probably have a very obvious target when gold really rips where the GDX is going to go. And you're looking at like a $35 breakout to maybe $65. Percentage wise, that is a massive move on the GDX. So yeah, I think if you're trying to leverage it, you'd play the GDX. You also have those triple and double gold ETFs, but remember those time decay as well.
Yeah, the Jung one. I mean, I saw that one. Its leverage got totally blown out last year in those extreme moves, and I think it went to like almost zero with a reverse split or something. Amazing. So I got to say, I wasn't in it, but I'm never going to touch one of those 3x leveraged ETFs.
Those leverages, and people don't understand this, but those leveraged ETFs are meant for short-term trading. So if you think the move is coming in a month, that's where you play it, but you never want to tuck those away in like a 401k or anything like that, because you'll inevitably lose money,
Yeah, I hear you. So Gareth, the big question in this past week and probably for the next couple of weeks is this taper, because they announced they're doing a taper. They announced they're taking it from 120 billion a month down to, I think they're taking it down 15 billion, and they're going to gradually accelerate it. I mean, he's talking in the past couple of days about accelerating that taper in December. Is that really realistic? I mean, the way this market's going, if you tighten everything, won't they just freak out?
Yeah.
And it's not even tightening. It's just sort of a little bit reducing, right?
Right. But the market's so not used to that. The market's used to kind of the drugs being pumped in unlimited amounts, never going back. And every time the market kind of dips a little bit, the Fed in the past has always kind of backed off, right? We saw that in 2018. But the question now is, this is where things get really interesting. Powell was just reappointed, right? So now you have a reappointment from a president who has midterms in 2022, and inflation is the top concern for middle income and lower income voters. So, this is where it gets really kind of political and weird, where you have to say, okay, well, is he being a little harsher, and does the market worry about that the Fed is going to try to push back on inflation, which is not good for the markets because of the midterms coming up? Maybe there's some political stuff going on there. So I think that's an issue. I also think that the Fed is in a box at this point. They've kind of screwed themselves, right? If they continue to print, the bubble gets bigger and eventually collapses and inflation goes to 15%, 20%. We have the Weimar Republic kind of thing. And then if you go against it, then the markets are going to collapse. Where do they exit? What ends up happening here? And again, I've said it forever, is that they'll continue to print at certain points because things will get so bad. But eventually a major catastrophe collapse happens in the financial system. This may be 5, 10, 15 years away, but at some point the Fed will no longer exist in its current form. They will be blamed. They will be the scapegoats. And you'll actually have some sort of digitalized currency come out that has restrictions on printing, just to kind of combat this issue that the Fed has created. And I even think the people will demand the government have some sort of balanced budget. So, I mean, this is a pivotal period in the history of this country coming into play here. And it's something that, as a spectator, I love being a trader because I can be in and out. And I think, I would not feel comfortable being all in long, and I wouldn't necessarily want to be all in short right now either.
On that note, thank you very much for joining us, Gareth. We really appreciate it. And we'd love to talk to you again in 2022 as the market develops.
Wonderful. Thank you guys for having me very much.
Thank you, Gareth.